The harsh second wave of COVID-19 has led to Mayday calls across the country, resulting in localized restrictions. Economic activity is expected to be impaired due to the same, and GDP recovery is likely to take longer than earlier envisaged. However, equity market continues to remain far more resilient. This disparity is a result of some important differences in their constituents. Within the Nifty 50 index, financial services constitute 38% while it comprises only 6% in GDP. The largest banks are well capitalized and are primed for the next cycle of corporate credit growth. Sectors like trade, hotel, transport and communication, which account for 18% of GDP, and real estate and professional services, which account for 15%, have a relatively higher impact from lockdown. However, within the Nifty 50, these sectors hardly have any representation. The fourth quarter of financial year 21 earnings season has maintained the momentum of the previous quarter. Key drivers have been metals, private banks, NBFCs, and IT. When adjusted for expected financial year 21 earnings APS growth, the temperature gauge index is in the fair value zone. Hence, for incremental allocation to equities, we suggest 50% deployment immediately and 50% to be staggered over a period of 3 to 6 months. We continue to maintain bias towards multi-cap and select mid and small cap strategies across MF, PMS and AIF platforms. RBI has again been proactive to provide support to the economy at this crucial juncture. Creation of a special liquidity window for aiding healthcare infrastructure, and enabling swift credit to weaker sectors by providing incentives to banks is a big positive. The GSEC acquisition program has also ensured stabilization of the longer end of the yield curve. In the current fixed income scenario, we suggest following a barbell portfolio approach, that is, having core allocation to high-quality accrual-oriented funds with short maturities, from 2 to 5 years, complemented by 15 to 20% allocation towards long maturity and high-quality roll-down strategies. Tactical allocation to select credit-oriented funds, high-yield MLDs can help enhance the yield on such portfolios. Gold should be treated predominantly as a hedge against heightened volatility. Investors can participate through sovereign gold bonds, gold funds and digital gold. To ensure that investment portfolios stay in good health, we suggest investors to stick to their asset allocation and to revisit their investment charter to ensure that portfolios are positioned appropriately.